So welcome everybody to You're Graduating, so what happens with your loans? Good afternoon to all of you who have joined us today. My name is Yvonne Gonzalez, and I am a financial aid coordinator at CUNY SPS. Today we will discuss what happens next for those of you who are graduating and have, in the course of your academic career, borrowed loans. As we go through the presentation, please feel free to submit questions. So first, let's go over the several types of federal loans which you may have borrowed. There are subsidized, unsubsidized, Perkins, and Graduate Plus loans. The most commonly borrowed loans here at CUNY SPS are the subsidized and unsubsidized loans. Subsidized loans are only available for undergraduate students with financial need. Unsubsidized loans, however, are available to both undergraduate and graduate students regardless of financial need. There are annual as well as aggregate limits. For instance, undergraduate students can borrow up to $12,500 in one academic year, and of this amount, no more than $5,500 can be subsidized. The aggregate limit is $57,500, of which no more than $23,000 can be subsidized. Graduate students can borrow up to $20,500 in one academic year. The aggregate limit for graduate students is $138,500, and this includes loans borrowed as an undergraduate student. The Perkins loan was another type of loan that a few of you may have borrowed. However, funding for this loan ceased a few years ago, so there were no new Perkins loans awarded, but you may have borrowed at some point in your college career. Graduate Plus loans are only available to graduate students and have no specific annual maximum. However, the amount of the Plus loan and any other aid cannot exceed the cost of attendance. The principal balance of a loan is the initial amount which you borrowed. However, you will not just have to repay the principal balance. Loans accrue interest. The interest is the finance charges you pay on the loan. For subsidized loans, your interest payments are made by the U.S. Department of Education while you are enrolled at least half-time, and for the first 6 months after you have ceased attendance of at least half-time. This is not the case for unsubsidized loans. What happens to the loans once your enrollment has ended due to, for instance, your graduating? First, you will be asked to complete exit counseling. We will send you an email, and you will see it as a to-do item on your CUNY First account. Next, your loans will enter into the grace period. The grace period for subsidized and unsubsidized loans is the first 6 months after you are no longer enrolled at least half-time. The grace period for the Perkins loan is 9 months. Graduate Plus loans have no grace period. One important fact to keep in mind about grace periods: if you at some point took a semester off or enrolled in fewer than 6 credits, you would have already started the clock on the grace period for loans borrowed up to that point. If you did not use up all of the 6 months at that time, now that you are graduating, those same loans will re-enter grace period, but will have a shorter period of time. For instance, if you had used 4 out of the 6 months, you would only have 2 months of grace period left now that you're graduating on those particular loans. When grace period ends, you will be required to begin repayment of your loans. Now, you could potentially make payments towards your loans during the grace period, but are not required to do so during that time. It is critical that you use your grace period to find out how much you borrowed, find out what types of loans you have borrowed, find out who your loan servicer is, and find out which is and sign up for the most beneficial repayment plan for you which you qualify. In order to find out how much you have borrowed as well as the types of loans you had, visit nslds.ed.gov. This federal website will give you your entire history of federal loans and even the Pell Grants you may have used. When you have selected Financial Aid Review and logged in, you will see a list of your loans. Clicking on the number of the loan will then allow you to view specifics of that loan, including the loan period date, the principal amount, interest accrued on the loan, and the status. You will also be able to determine who your loan servicer is. The loan servicer is the agency to whom you will be making payments once your grace period is over. They will be contacting you during the grace period. If you have not already, this is a good time to set up your online account with your servicer. Now that you have navigated through your loan history and created an account with your loan servicer, you will have to figure out which repayment plan is best for you. You can use a repayment estimator from studentloans.gov to help determine the best option for you. Once you have logged in to studentloans.gov and selected the repayment estimator, you will fill in information about your loans, filing status, family size, marital status, and income. This will result in an estimate of your monthly payment, as well as the payment plans for which you may qualify. There are two main categories in which the repayment plans fall: those that are based on your income and those not based on your income. The income-driven repayment plans are pay-as-you-earn or PAY, revised pay-as-you-earn repay, income-based repayment IBR, and income contingent repayment ICR. Let's go over some of the main points for the income-driven repayment plans. For the four noted, you will have to update your income and family size every year as a monthly payment amount is recalculated annually. Any amount not paid after the specified time frame is forgiven. For repay, you have 20 years if you were in an undergraduate program or 25 years if you were in a graduate program. For pay, you have 20 years. For IBR, you have 20 to 25 years. And for ICR, you have 25 years. However, you may have to pay income tax on the amount that is forgiven. Generally, the monthly payment amount will be a percentage of your discretionary income, 10 to 20% depending on the plan. Some are only open to borrowers with direct loans as opposed to FFEL, Federal Family Education Loans, so be careful when selecting a plan. FFEL loans were essentially the majority of loans awarded prior to 2010 and whose funding came from banks and were guaranteed by the U.S. Department of Education, whereas direct loans are funded directly by the U.S. Department of Education via the Treasury. There is an additional repayment plan option available only to those with FFEL loans called Income Sensitive Repayment Plan. To qualify, students must have low income and payments change based on your income. When you visit the student aid site listed, you will be able to see this chart that provides an overview of the repayment plans, including the eligible loans, monthly payment, and time frame, as well as eligibility and other information of each plan. In this case, we have the revised pay-as-you-earn plan. Those repayment plans not based on your income are as follows. There's the standard repayment plan. For this payment plan, the monthly amount is fixed so that you pay off the loan in 10 years. If you do not select a plan yourself, you will be automatically placed into this one. Then there's graduated repayment plan. Similar to the standard repayment plan, you will pay off the loan in 10 years, but the amount will start off smaller and then gradually increase over time. Finally, there's the extended repayment plan. With this plan, you'll pay off the loan in 25 years and the payments can either be fixed or graduated. Regardless of which plan you initially choose, you can apply to change the plan at any time. Here again, an image of the chart with the overview of the repayment plans, this time for the standard repayment plan. If you have a Perkins loan, you should contact the school in which you borrowed the Perkins loan. Unlike with the subsidized, unsubsidized, and plus loans for which you will have a loan servicer, for the Perkins loan, either the school or an agency they employ manage the loan as well as repayment. If you are having trouble making payment, the first thing you should do is contact your loan servicer to explain your situation and together determine what options are available for you. It is possible you may qualify for either deferment or forbearance, but you will have to request either if you meet the criteria. The biggest difference between deferment and forbearance is that with deferments, you may not have to pay the interest on certain loans, while with forbearance, you will. The chart here shows which loans you are not responsible for paying interest, as opposed to those you are responsible during deferment. Some of what can make you qualified for deferment include being enrolled at least half-time, being enrolled in an approved rehabilitation training program for the disabled, being unemployed or unable to find full-time employment, be experiencing economic hardship or serving in the Peace Corps, being on active duty military service. If you visit the site listed in the prior slide, studentaid.gov, ed.gov, you can see all the reasons for which you can apply for deferment. To qualify for discretionary forbearance, which means it's up to your loan servicer, you must be temporarily unable to make monthly payments due to financial difficulties, medical expenses, or a change in employment. To qualify for a mandatory forbearance, you must be serving a medical or dental internship or residency program, have a monthly payment amount that is more than 20% of your monthly gross income, must be performing teaching service that would qualify you for teacher loan forgiveness, or be a member of the National Guard who has been activated by a governor but is not eligible for a military deferment. For other reasons, you would visit the student aid site listed. Taking these steps can help ensure that you do not have your loans go into default. A loan goes into default when you have missed multiple payments. There can be severe consequences if you default on federal loans, including, but not limited to, the entirety of the loan plus interest is due immediately. Deferment and forbearance are no longer an option for you. You are no longer eligible for additional federal aid. Your credit will be negatively affected. Any tax refunds or federal benefits to which you may be entitled can be withheld and used to pay your loan. Your wages will be garnished. You can be taken to court by your loan servicer. Other consequences are listed on the student aid website. To get out of default, make sure to contact your loan servicer to discuss your options. Your options may be to consolidate your loans, rehabilitate your loans, or pay the entirety of the balance, which for most is not feasible. Some of the benefits for consolidating your loans is having one servicer as opposed to possibly having many, one monthly payment, and having a fixed interest rate. Rehabilitating your loans is a process by which you have a written agreement with your loan servicer where you promise to make 9 voluntary and on-time payments. You will have to make those payments, after which your loan will no longer be in default. Through rehabilitation, your default will be removed from your credit history. It is the only option where this is the case, and it is also a one-time option. There are certain programs by which you may have your loans forgiven after certain conditions are met. The first is PSLF, Public Service Loan Forgiveness. To qualify, you must work for a government agency or some nonprofit organization, work full-time, have direct loans, have set up an income-driven repayment plan, and make 120 qualifying payments. Any amount remaining after the 120 payments have been made is forgiven, and this amount will not be taxed. Then there's teacher loan forgiveness. To qualify, you must teach full-time for 5 consecutive years at a low-income school. After the 5 years, up to $17,500 can be forgiven. Okay, so it looks like there are no more questions, so we'll just move on. Managing the repayment of your loans may seem daunting at first, but if you take it step by step, you should be able to handle it. Make sure to stay in contact with your loan servicer, especially when there is a change in your circumstances that could affect your ability to pay. You do not want to miss payments and fall in danger of default. Thank you for your time. I've included the links from prior slides in useful resources.